Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Which is better, active or passive investing? That's the question we ask and answer today on the College Investor Audio Show. Hey, thanks for being here. So anyone even remotely familiar with the investment community will know that there is a constant debate raging over this particular question and topic. In reality, the best type of investing will depend on your investment goals. With that in mind, let's take a closer look at the nitty-gritty details of passive versus active investing. Once you have the information you need, you can decide for yourself which is better fit for your portfolio. So, first we take a look at passive versus active investing. It's important to understand what the terms passive investing and active investing actually mean. Let's start with the basics. First, what is passive investing? Well, passive investing is associated with a hands-off approach. So as a passive investor, you're likely investing for the long term. With that, you aren't interested in making regular trades to achieve short-term gains. Likewise, you aren't trying to beat the market with sophisticated investment strategies that require constant portfolio updates. Instead, passive investors want to set up their investments and just let the market take care of itself. Essentially, passive investors are sticking to the idea that time in the market is better than timing the market. Of course, that doesn't mean that passive investors completely ignore their portfolios. No way! In fact, regular portfolio rebalancing is an important part of any passive investment strategy. However, passive investors will likely check in their portfolio on a minimal basis of once a quarter or even less than that. What is active investing? Active investing involves a more hands-on approach. With an active investment strategy, an investor or their money manager watches the market constantly. As the market fluctuates, the investor looks for opportunities to improve their portfolio. Typically, active investors are concerned with those short-term gains. An active investment strategy involves a considerable amount of time and research in an effort to outperform the market. Unfortunately, for active investors, the vast majority are unable to outperform the market. In fact, check this out, over 75% of actively managed funds failed to beat the market over a 5-year period. That is according to S&P Dow Jones indexes. So, what are the advantages and disadvantages of active versus passive investing? Each investment strategy comes with its pros and cons, of course. So here's a closer look at the advantages and disadvantages of these investment styles. First, the advantages of passive investing. Passive investing has several advantages, including lower fees. Passive funds don't require a fund manager to pick stocks. With that, the costs can be considerably lower. Tax efficiency. Passive investors employ a buy and hold mentality. This creates fewer taxable events to minimize capital gains each year. Ease of understanding. A passive fund will have a clear definition of the assets included. Disadvantages of passive investing. As with all financial strategies, there of course are some drawbacks to consider with passive investing. These include limited options. So as a passive investor, you'll likely have to choose from a selection of predetermined indexes. Although you can work with many different brokerage accounts, the basics of many index funds are very similar. No opportunity to beat the market. Passive investing is designed to keep pace with the market. With that, you give up any chances to beat the market. Here are some advantages of active investing. Several advantages, including flexible opportunities. That's really a big one. An active fund manager can make adjustments to the portfolio at any time without any requirements to stick to a particular index. Complex investing strategies at play, too. That's a huge advantage. Active fund managers are free to try various techniques, including short sales and market timing, to boost their performance. Here are some disadvantages. Like we talked about before, higher costs. The human element of an actively managed fund makes this strategy more expensive. If you decide to actively manage your own portfolio, you should expect to sink in considerable time costs. There's no guarantee of beating the market. As we just mentioned earlier, most actively managed funds don't beat the market. With that, you may be paying more to have your money in an actively managed fund that doesn't even beat the market anyway. Passive versus active investing, so which one is best for you? Well, as we found out today, both passive and active investing are appropriate strategies for investors, but you're just going to need to decide for yourself which is the right option for you. If you want to take a hands-off approach to investing, of course, a passive style is going to be the better choice. You can expect reasonable returns that are consistent with market averages over the long term. As a passive investor, you won't have to put in too much time or effort to create a portfolio that will align with your investment goals. Additionally, you can ensure that you aren't overpaying for investment funds. That's huge. Okay, so on the other hand, let's say you're very interested in learning the ins and outs of the market. If you want to create a personalized investment experience and have a considerable amount of time to commit to this strategy, that's a big key, then active investing might be right for you. Investors with a short-term mindset will also benefit from an active approach. But before you dive into the deep end of an active approach to investing, take some time to learn the swim, or the basics. Because without a basic understanding of the stock market, it's better to stick to a passive approach until you have enough time to commit to learning this skill. Take some time. Okay, so here are some final thoughts. As an investor, a passive or active style may be best suited to your needs. Most importantly, neither type of investing is outright better than the other. However, each strategy will serve the needs of a particular type of investor better. Before you decide which one is best for you, please take some time to consider your investment goals. If you need some help deciding which investment strategy is right for you, take a look at our ultimate guide at thecollegeinvestor.com. Thanks so much for being here today. We're so honored that you took the time to listen. Please share this with somebody else if you found it helpful and you think it can help them too. Also, again, the website, thecollegeinvestor.com. Thanks again. We'll talk to you again real soon.